Bismillahirrahmanirrahim. Selamat datang ke Bank Negara Malaysia bersempena dengan taklimat laporan tahunan 2015 dan laporan kestabilan kewangan dan sistem pembayaran 2015. The annual report will provide an assessment of the outlook of the global and domestic economy and the initiatives taken by the central bank to strengthen our economy. The Financial Stability and Payment Systems report, also being released today, will cover our assessment of the stability of the financial system and the policies and financial reforms that were implemented in 2015. In 2015, despite a very challenging global and domestic economic environment, the Malaysian economy recorded a growth of 5%. Malaysia remains amongst the faster growing economies in the region. As we can see, that growth in the region was between 7.3 to 0.7%. Growth was mainly driven by private sector demand, private consumption, while supported by continued income growth and stable labour market conditions. It was, however, weighed down by weaker sentiments in the adjustment to rising costs of living. Private investment continued to register positive growth, driven by investments in the export-oriented manufacturing and the services sector. The effect of net exports on growth, however, was negative, as imports grew at a faster pace compared to exports. In 2016, the global expansion is likely to continue, but is expected to remain modest with higher downside risks. In the advanced economies, the growth momentum will remain modest, supported by a moderate economic expansion in the United States and an improvement in the euro area. In Asia, growth is anticipated to be underpinned by private domestic demand, supported by stimulus measures in a number of economies in the region and supportive monetary conditions. While global trade is expected to improve with the expansion in global growth, the trade intensity is expected to remain weak due both to structural and cyclical factors. Structural factors include the diminishing impact of previous episodes of greater trade integration and slower expansion of global value chains and the slower investments by corporates. Cyclical factors include the subdued global demand amid high economic and financial uncertainty in the post-crisis period. Amid an environment of low commodity prices, global inflationary pressures are expected to remain subdued, and in 2016, global commodity prices are projected to remain low on account of modest global demand conditions and continued excess supply situations, particularly for crude oil. The subdued commodity price outlook will contain inflation in several of the advanced and emerging economies. Monetary policies in the major economies are, however, expected to remain divergent in 2016. We have seen the European Central Bank and the Bank of Japan continue to be biased towards further monetary accommodation, while the Federal Reserve Bank is expected to remain on its interest rate normalization process. Despite this expected divergence in monetary policy direction, the overall monetary policy stance is still accommodative to provide further support to reinvigorating economic activity. Let me now turn to the Malaysian economy. The Malaysian economy is expected to expand at a more moderate pace of 4 to 5% in 2016. Domestic demand will be the key driver of growth, sustained primarily by private sector economic activity. The external sector is also expected to support growth following the recovery in growth in the advanced economies and the continued growth in the regional economies. All economic sectors except for agriculture are expected to expand, with the services and manufacturing sector being the key drivers to overall growth. All components of demand are expected to turn positive in 2016, with domestic demand continuing to be the main driver of growth. The pace of expansion of domestic demand is, however, expected to be slower in 2015 amid ongoing adjustments by consumers and investors in the challenging economic environment. Public sector expenditure growth is expected to remain moderate in 2016, but continue to be supportive to overall growth. Meanwhile, net exports is expected to turn around to record a positive growth in 2016 due to the stronger growth in exports following the continued recovery of the global economy. Private consumption is expected to grow by 5.1% as households continue to adjust to the effects of price increases and the greater uncertainties. Government measures to increase disposable income will support consumption spending, and this includes a reduction of the EPF contribution by 3 percentage points, higher cash transfers, and additional tax relief, and further lift will be provided by the increase in the national minimum wage and the salary increment for civil servants, both effective July 1, 2016. The growth of private consumption is also supported by the stable labor market conditions, while wages are expected to continue to grow at a moderate rate, driven by externally oriented industries and the trade performance improves. Private investment is projected to expand by 5.5% in 2016, mainly reflecting investment in the services and manufacturing sectors, offsetting the lower capital spending in the mining sector in an environment of low oil prices. The services sector is projected to be supported by the continued investment activities in telecommunications, transport, and storage projects, and this is a number of these are ongoing currently. Meanwhile, the manufacturing sector is expected to remain supported by capital spending in the export-oriented industries such as the electrical and electronics and petrochemical industries. Export growth is projected to remain positive in 2016. Growth will be supported by the continued expansion of manufactured exports, which is likely to cushion the weakness in commodity exports. The growth of gross imports is also projected to expand further in 2016. More importantly, the increase in imports will be mainly accounted by intermediate goods and capital goods that are used for production and for the domestic investment activities. The well-diversified export structure across products and markets have accorded the Malaysian economy the ability to withstand the more challenging external developments and has enabled Malaysia to sustain our global competitiveness. For 2016, the current account balance of the balance of payments is expected to remain in surplus at 1 to 2% of gross national income. The goods balance is projected to record a surplus, or but a smaller surplus, driven by the sustained performance of the manufactured exports and commodity surplus. The deficit in the services and income accounts are expected to remain due to the continued reliance on the foreign services providers and the significant profits earned by foreign investors in Malaysia. Similarly, the savings investment gap is narrowing due to the faster growth in domestic investment, which will boost economic productivity and export capacity of our economy in the future. In the foreign exchange market, the ringgit has appreciated against the currencies of the major and regional economies since September of 2015. Ringgit volatility, however, has been high, and uncertainties in both the global and domestic developments may lead to continued ringgit volatility with spillover effects on financial markets. Despite the high capital flow and financial market volatility, conditions in Malaysian financial markets have remained orderly. Money market rates have continued to reflect movements in the OPR, while the domestic bond yields have remained stable. In the equity markets, while the FBM KLCI declined, that is by 3.9% in 2015. This is in line with most regional indices. Malaysia will be able to withstand the effects of the significant shifts in capital flows from the more developed financial markets and on account of the more developed financial markets that we have in our country and the sound banking system that are capable of intermediating these flows effectively. These are reinforced by the buffers that we have in place. This has ensured the orderly function of the domestic financial system and its ability to support our economy. Non-resident holdings of Malaysian government bonds have also been relatively stable at about 30% of outstanding value of government bonds, amounting to 176 billion ringgit as at end January this year. And this is important because non-resident holding of Malaysian government bonds are now included in the definition of external debt, even though it is ringgit denominated. The majority of the investors of Malaysian government bond market are, however, medium to longer term investors, mainly asset managers, the insurance industry, pension funds, and other central banks. The international reserve position of Bank Negara Malaysia has stabilized since October of 2015, and as at March 15th this year, reserves amount to $96.1 billion. It should be mentioned that the progressive liberalisation of foreign exchange administration rules has led to some decentralisation of our reserves in the form of higher holdings of foreign assets abroad by banks and corporates. The availability of external assets enable these entities to meet external debt obligations and thereby do not create a claim on our international reserves. Malaysia's external debt position remains manageable at 834 billion ringgit, or 72% of GDP as at end 2015. The higher external debt in 2015 is partly due to the valuation effects following the depreciation of the ringgit. However, now, of course, with the recovery of the currency, there is some improvement in these debt levels. Also, the profile of the debt external debt shows that 36% of the external debt is denominated in ringgit and thereby not subjected to valuation effects of the ringgit fluctuations, and 58% of the external debt is in the medium to long-term tenure, which limits the rollover risks. And the overall debt service ratio remained low at 22.6% of exports of goods and services. Foreign currency debt is low at 41.8% of GDP. This is much lower compared to the time of the Asian financial crisis, when it was 60%. The external exposure of banks and corporates are generally hedged, as was mentioned earlier, either by a natural hedge through foreign currency earnings or through the use of financial instruments. Importantly, Malaysian entities have a sound level of external debt, external assets to meet their external debt obligations. Turning now to inflation. Headline inflation is expected to average between 2.5 to 3.5% in 2016, and the higher inflation reflects mainly the upward adjustments of several administrative price items since October 2015, and also the weaker exchange rate. The inflationary pressures is partly mitigated by low global energy and commodity prices, subdued global inflation, and more moderate domestic demand. And while inflation is expected to remain low, rising cost of living continues to affect low and middle income households, particularly those living in urban areas. Data has shown that inflation rates are consistently higher for low-income households in urban areas such as in Kuala Lumpur. 60% of the urban low-income households' expenses are on food items and housing, which generally register higher inflation. In terms of monetary policy, as we already know, monetary policy in 2016 will focus on ensuring monetary conditions remain supportive of growth of the domestic economy in an environment of price stability. The bank will continue to ensure liquidity is sufficient to support the orderly functioning of the money and foreign exchange markets. Financing will continue to remain supportive of economic activity with sustained financing through the banking system, development financial institutions, and the capital markets. In 2015, the total level of loans disbursed by the banking system and development financial institutions remained strong and were broadly based across the economic sectors. In particular, loans disbursed to SMEs increased by 14.4% to 273 billion ringgit, and this trend is expected to continue going forward. Funds raised from the capital market amounted to 101.4 billion in 2015 and is expected to be sustained going forward given the continued investment activities. Despite volatile financial markets, lending rates from the banking system remain stable, while the cost of financing from the capital market continues to remain favorable for fundraising. In 2015, the average lending rate for businesses was 5.26%, lower than its long-term average of 5.64%, while SMEs were still able to obtain financing at rates below their historical average of 6%. Borrowing costs from private debt securities market also remained relatively stable and low. A strong domestic investor base in Malaysia has allowed financing requirements to be met from domestic sources and less reliant on external sources of funds. And this is important. because we have a well-developed bond market in general. This gives the opportunity for domestic corporates to raise funds from domestic sources. In summary, the Malaysian economy is projected to grow by 4 to 4.5% in 2016, with inflation to be in the range of 2.5 to 3.5%. We recognize that there are downside risks to growth arising from a more moderate growth in the major economies, further weakness in the commodity and energy prices, and further expenditure adjustments by households. These remain the risks that our economy faces. In the prevailing environment, Malaysia, however, has strong macroeconomic fundamentals, and earlier structural adjustments and reform provide the nation with resilience in managing these risks. We have a more diversified sources of growth. We have favorable external position with the current account of the balance of payments, which is projected to remain in surplus. We have a strong and solid banking system. We have well-developed capital markets, and we also have the policy space, which provides Malaysia the enhanced ability to manage these challenges. Now, this concludes the presentation, but I would like to highlight, of course, together with the annual report, we publish our financial position as at December 31st, 2015, and I'm pleased to report that for this year, our total assets amounted to 440.6 billion ringgit, and the net profit for the year is 7.79 billion, and this is the record performance for Bank Negara Malaysia, and we have allocated 4.7 billion ringgit to be transferred to our risk reserves, 3 billion as dividends to the federal government, while the remaining 94 million to be transferred to the General Reserve Fund. So this concludes the annual report, and I would like now to present the financial stability report, the financial stability and payment systems report. I would also like to mention that this is the 10th report, so this is the 10th anniversary of the annual publication of this report that highlights the bank's assessments of risk to financial stability in our financial system. It highlights the capacity of the system to manage these risks and challenges, and the policy response and measures taken by Bank Negara to develop and bolster the resilience of the financial and payments systems. Domestic financial stability was preserved throughout 2015 with a positive outlook expected in 2016. The Malaysian financial institutions continue to remain strong, to continue to maintain strong capital and liquidity buffers, providing high shock absorption capacity against the more challenging external and domestic environment. These conditions are further reinforced by sound lending and provisioning practices and will continue to provide firm support for domestic financial intermediation. Growth in household debt, and this is one of the risks to financial stability. Growth in household debt moderated for the 5th consecutive year since 2010 to 7.3%. This was mainly due to the sustained slower expansion in personal financing, which grew by 4.6%. And this is as opposed to more than 20% in 2010. The share of borrowing by households that earn 3,000 or less a month declined further, reflecting continued improvements in the loan affordability assessments. In the housing market, the growth of the average house prices has moderated to about 8%. I would like to mention that the growth of total house financing has, however, remained high at 11.7%, and this is mainly for eligible first-time buyers continue to have access to financing, and it amounts to 3/4 of the housing loan borrowers. That means 3/4 of the housing loan borrowers are by first-time buyers. The corporate sector domestic borrowings increased by 9.5%, reflecting the increased expenditures for private investment activities and public infrastructure projects. The weaker ringgit resulted in higher external borrowings in ringgit equivalent terms. Notwithstanding this, 54% of the corporate borrowings have lower currency and funding risks. This include trade credits and intra-group borrowings by multinational companies that have operations in Malaysia. Aggregate Malaysian corporate leverage increased to 46.8% of GDP and have remained within prudent levels. Overall debt servicing capacity of corporate borrowers also remains sound. Accordingly, Malaysia also has a lower share of corporate debt at risk compared to other countries in the region. Aggregate surplus liquidity of banking institutions placed with the bank remained high at 178.3 billion ringgit as at January 2016. Despite the more moderate expansion in deposits, financial intermediation activities continued to be supported by ample liquidity conditions. Initiatives by the bank to manage liquidity conditions in the banking system include the establishment of a committed liquidity facility and the lowering of the statutory reserve requirements. Since January this year, the bank also published broader measures of liquidity risk to better reflect the underlying changes in bank funding structures as a result of greater financial deepening in Malaysia. The risk of contagion arising from banks' external exposures and overseas operations continue to be well managed and contained. Net external liabilities of the banking system increased slightly to 139 billion ringgit in 2015. This was predominantly attributed to the operations of locally incorporated foreign banks, which receive funding from their head office. Domestic banking groups continued to maintain a net external asset position, reflecting their capital investments in regional banking operations and centralized liquidity management practices. The performance of the overseas operations of domestic banking groups remained positive, and this was underpinned by the broadly stable asset quality of overseas lending portfolios and the continued prudent management of credit, funding, and currency risks. The multi-year solvency stress test, as you all know, we conduct a stress test on the financial institutions every year, and these tests continue to affirm the strong capacity of financial institutions, both at the system and institutional levels, to withstand severe macroeconomic and financial strains. Under simulated adverse stress scenarios involving economic downturns and protected slow growth over a 4-year period, the aggregate capital ratios of the banking system and all major banking groups remained above the minimum Basel III requirements, and these results do not take into account any capital raising actions that may be taken by the banks to boost their financial position during the stress period. During the year, financing by the banking system to SMEs continued to expand by 14.4% to 273.3 billion ringgit. Today, loans to SMEs account for half of the total business loans from the banking system as banks continue to diversify their financing activities. The year also saw Malaysia's admission into the renminbi Qualified Foreign Institutional Investor Program. Malaysia is the 14th jurisdiction to be admitted into the program, and this RQF program, would promote the utilization of the renminbi as a currency of settlement and increase renminbi-denominated financial product offerings in Malaysia. This will in turn contribute to the further deepening of Malaysia's foreign exchange market. Efforts to foster greater financial integration in the region intensified during Malaysia's chairmanship of ASEAN in 2015. This includes the conclusion of the ASEAN Banking Integration Framework, ABIF, in March 2015. The endorsement of a broad framework by the ASEAN finance ministers and central bank governors to guide the financial integration process also was concluded for beyond 2015. To facilitate cross-border offerings of collective investment scheme, that is CIS products, within ASEAN, the bank accorded several foreign exchange administration flexibilities. In the area of the use of local currency to settle trade, Bank Negara Malaysia signed a memorandum of understanding with the Bank of Thailand to operationalize a local currency settlement framework to promote the use of ringgit and Thai baht for the settlement activities of our bilateral trade with Thailand. In the insurance and takaful sectors, the prudential standards were strengthened to promote more robust capital and financial management practices. In addition, a number of key reforms are being progressed to improve consumer outcomes and to promote the long-term sustainability of the sector. Central to these reforms are the implementation of life insurance and family life takaful framework and the phased liberalisation of the Motor and Fire insurance tariff in the general insurance sector. Collectively, the reforms will provide better value and quality of service for policyholders, encourage greater product innovation, and improve efficiencies, as well as addressing price distortions. The initiatives implemented since 2011 under the new motor tariff framework have resulted in faster claim settlement, lower complaints, improved loss ratios, and fewer declined risks. This has prepared the ground for further liberalisation of the Motor and Fire Tariffs, which will further enhance the benefits to consumers and promote the long-term sustainability of the industry. An important priority pursued by the bank in promoting greater financial inclusion, and significant progress has been achieved in terms of access to and more effective use of financial services, as well as the level of satisfaction with the services provided. And this, in turn, will support a more balanced growth. And in the report, we highlight all the major advancements achieved in the area of financial inclusion. And the focus now will be on the more effective utilization of financial products and services. This is supported by measures to improve financial awareness and understanding and product offerings for the lower income groups. This is important because we want to achieve balanced growth. It is balanced growth that will become more sustainable. The amendments to the Development Financial Institutions Act, DFIA, which came into effect in 31st January this year, will further strengthen the capacity and capability of our development financial institutions to support Malaysia's socio-economic development and promote inclusive growth. The strengthened legislation will contribute towards ensuring that DFIs are financially sound and sustainable and well managed in order to achieve their specific mandates in a financially sustainable manner. The provisions in the DFIA on corporate governance, business activities, and the scope of the bank's regulatory oversight have been significantly enhanced. And the amended Act also incorporates new provisions for the regulation of Shariah governance and consumer protection with expanded enforcement tools to ensure compliance. During the year, measures were also taken to expand redress and debt resolution arrangements that are in place for financial consumers. A financial ombudsman scheme is expected to commence operations in June this year. This scheme will assume the current role of the Financial Mediation Bureau with an expanded scope for dealing with disputes within its purview, and strengthen governance and operational arrangements to enhance its effectiveness. Then AKPK, our debt management program, was also expanded to include borrowers of credit cooperatives and Malaysian Building Society Berhad, who can now obtain assistance from AKPK to manage their debt. That is the Credit Counselling and Debt Management Agency. Also important has been a continued focus on financial education that is more targeted, which leverages more effectively on technology. Turning now to the Islamic financial system, our Islamic financial system continues to be among the most developed in the world, and during the year, a key development was advancing further investment accounts, and these new investment accounts were introduced in response to the Islamic Financial Services Act that clearly distinguish deposits and investment accounts in line with their underlying Shariah contracts. An investment account platform was also launched to serve as an online marketplace for investors and entrepreneurs to participate in the investment accounts. The development of Islamic finance continues to be firmly supported by a comprehensive Shariah contract-based regulatory framework. To date, the bank has issued a total of 13 key Shariah standards and 5 operational guidelines. On the e-payments agenda, there's migration away from checks to e-payments. Finally, we are seeing the results. The use of checks declined by 16% in 2015 as compared to a decline of only 1.6% in the period between 2011 and 2013. For the first time in 2015, interbank gyro transactions surpassed the number of checks cleared, underscoring the increasing confidence in the use of e-payments. The payment card reform framework issued in July 2015 aims to widen the acceptance and usage of debit cards to reduce the need for cash. There's now a more rapid deployment of card terminals to accept e-payments. The bank will continue to foster an enabling environment with focus on 5 key areas, which are the price signal, the industry incentive structure, access points, quality and value, and public awareness and confidence. Finally, a comprehensive infrastructure has been instituted to raise the level of professionalism and financial ethics in the financial services sector workforce, and focusing on the areas of technical competencies, ethics, and leadership. Over the years, the learning institutions for the financial services industry have evolved to respond to the needs to maintain the highest standards of industry excellence. This year saw a number of achievements and efforts to further enhance the professionalism of the financial sector workforce. This included the introduction of the third and final level of the Chartered Banker Program for banking professionals by the Asian Institute of Chartered Bankers, in collaboration with the training provider Asian Banking School. In 2015, more than 1,300 students enrolled in this Chartered Bankers qualification. Complementary to the initiatives above, the Financial Sector Professional Board, FSPB, published a voluntary code of ethics for the industry in January 2016 for adoption, which will set a high bar for professionalism and ethics in the financial services industry. In summary, the financial sector is in a much stronger position to manage and cope with the more challenging domestic environment and the external developments. Previous financial reforms have increased the flexibility and competitiveness of the financial system. Entering the more challenging environment from a position of strength, the financial institutions are well positioned to remain supportive of the financial requirements of the economy. The capacity of financial institutions to deal with severe macroeconomic and financial shocks is further reaffirmed from the regular stress tests that are conducted by the bank. The more diversified and deep financial system with presence of strong domestic institutional investors will continue to support the orderly market conditions. So going forward, the bank's priorities will focus on maintaining close vigilance over domestic developments and management of risk by the financial institutions, including their overseas operations. Continuing also with the implementation of global prudential standards and insurance reforms. And finally, strengthening interagency and cross-border arrangements because of the highly interconnected financial system that we have for the management of financial stability. And this includes operationalizing the cross-border regional crisis management framework. So this is what we have in place, and we have a high degree of confidence of our ability to maintain financial stability. So this concludes the financial stability report.